to the ACA conference in downtown Manhattan. I'm Jane King. With me is Cheryl Pate, the Senior Portfolio Manager at Angel Oak Capital Advisors. So great to have you here.
Great to be here.
So let's talk about what you do. Explain your job, and then we'll go into a little more detail.
Sure. I'm a Senior Portfolio Manager at Angel Oak, and I focus on the financial sector strategies that we manage. We manage a multitude of strategies across liquidity buckets, everything from open-ended mutual funds to private credit strategies, as well as a closed-end fund that focuses on financial services and most notably banks.
Okay, so, and this has been an interesting year for banks. Of course, in March, we saw the regional banks have all the problems. We've dealt with higher interest rates. How would you describe this year? How have you navigated all of this?
It has certainly been an interesting year, starting back with the failures back in March, and sort of the ensuing rethink of cost of funds. What do you pay for deposits? How do you think about the sector overall? Against a backdrop of rapidly rising interest rates. So I think, where we get comfort in a fundamental outlook for the year ahead is really, we've gone through several earnings cycles since the regional bank failures. And I think what they've really highlighted to us is the resiliency of the American banking system. Deposit costs have moved up, but so have lending yields. So margins remain healthy, though compressing. Everyone has been expecting these deposit betas to tick up very significantly. And there is still a lag effect as we get to the end of the Fed hike cycle. But that increasing pace is starting to sort of top out and decelerate now. So we feel pretty good about the top line prospects. And on the flip side, credit, which we've been concerned about even ahead of March, some normalization from very good levels, coming out of COVID. Yeah. We are starting to see normalization, but it's been manageable.
Yeah, I remember in March there was the whole banking system going to collapse, and really didn't have the dramatic result. Things kind of seemed to stabilize. How did you position your company and your advice during all of that time?
Yeah, I think where we, sort of thinking about it from the lens of we're predominantly fixed income investors in bank debt, we sort of slice the banking sector up into three pieces. You've got your large money center banks, the JP Morgans of the world. Then you've got, the regional banks, and then at the smaller end, the community banks. And we've seen traditionally the best value in the community bank sector. They're very sort of traditional business models that are very relationship driven. When we think about the changes to come, and we do think higher regulation is certainly coming down the pike here, I think where it mostly impacts is that regional space in the middle, where you have banks that started off small and have been growing fairly rapidly, sometimes out of footprint, sometimes into new business lines. That's probably where you see most change at the margin, where the regulations lightened up a little bit, and we'll come back down to hit that 100 billion and over cohort. So we sort of like a barbell strategy here. We like the fundamentals of the community banks, but we also see a lot of value in the big banks who have been regularly issuing debt since the events of March.
What about consolidation? I've been hearing talk that some of these banks will merge. What do you think of that?
I absolutely think that's going to be a trend to watch for in 2024. We've started to see it pick up this fall here a little bit. And I think, a couple reasons why. Number one, we're near the end of the Fed hike cycle, or at the end. But what that gives us is sort of clarity in terms of thinking of consolidation and combining balance sheets and having better clarity on what all the assets would be worth, particularly the securities. The other reason is increased regulation drives higher costs. So there is going to be much more value to economies of scale. So we do expect that you will see consolidation continue. It's been a trend for a number of years. For a lot of reasons, we think that's going to accelerate. And that's actually a pretty good benefit to bank debt, because you typically see that bank debt gets assumed by the bigger bank that's buying them, and you see spread compression and price appreciation.
Do you think it would be regional banks merging? Would it be big banks buying regional banks? What makes the most sense?
I think you still have, some reticence from the regulators to let big banks get any bigger.
Okay.
So I do think it'll be more in the regional space who are going to bear the brunt of the increased regulatory costs, but also the community banks where there has been a lot of growth over the years, but potentially more mergers of equals there and consolidating in contiguous footprints, for example.
Okay, very interesting to watch how this all unfolds. Thank you so much, Cheryl.
Thank you.